Three, two, one. So welcome to Newcastle Advisors Investment Forum. We're joined today by Jeff Neal from Ophir Asset Management. So Jeff is part of the Ophir team who manages over $2 billion across 4 investment strategies on behalf of super funds, family offices, private wealth groups, and individual investors. So welcome, Jeff.
Hi, Matthew. Pleasure to be here.
So maybe to get started, if you can tell us a little bit about yourself, your background, where you grew up, and how you ended up in funds management.
Yeah, no dramas. So I've been part of the Ophir investment team for about 8 years now. I grew up out in the Blue Mountains and did my university all via correspondence while doing an accounting job. The university I did via correspondence because I was pretty time poor working full time. Studied a Bachelor of Commerce accounting, did that, then did my chartered accountancy, and kind of fell into the funds management industry because Ophir was a client of mine in an old role, and then I'd changed roles, ran into one of the founders at the pub one time, and he said, "I remember you, you're a really great bloke, went above and beyond from a service perspective when you're the accountant. How would you like to be our first employee?"
Wow. So you were heading down the accountant path. You were always going to be an accountant.
Yeah, always going to be an accountant. To be honest, was a little bit bored being an accountant, but
Yep.
The skill set
happen with accounting.
Exactly, but the skill set was there, and kind of had the background there, and had done a lot of study. So I was pretty excited to be able to move across to an industry where I could still use the skills, but maybe the work was a little bit more exciting.
So do you think those fundamentals you learn in accounting has helped you in the funds management industry?
100%. Definitely the ability to read a profit and loss, read a balance sheet, understand what's behind the numbers and why the reporting is the way that it is, has been very, very helpful. I think a lot of people who start in funds management without that background find it's a pretty steep learning curve when you open up a set of financials.
100%. So what excites you, like comparing accounting to funds management? What excited you jumping into the investment side of things and looking at money every day?
I think from a starting point, definitely the speed that you're going at. In accountancy, you'd work on a client's job and then try and hit a time frame, and there's lodgement deadlines and all that kind of stuff. With funds management, it's go, 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 wake up early, do heaps of work. Stock prices are moving all the time. You need to know why, how things should be valued. You need to get across the news flow every day. There's ASX announcements on so many things to get across. You kind of get, once you're in that seat, you get a view of how, as a retail investor, it can be very hard to make money because you're doing your full-time job and then part-time reading all the announcements.
100%.
Yeah.
So you're talking about, so between 10 and 4, you're looking at the market itself, all the movements, and then outside of 10 to 4, you've got to do all your research and read everything and do all the study to make sure between 10 and 4 you're doing the right things for your investors.
Exactly. You've got to be careful not to price watch too much between 10 and 4 and still keep yourself productive and meeting management teams and doing your work, building your models. But yeah, definitely not just a 10 to 4 job. We kind of start around 7 o'clock in the morning and try and get out of the office by 5:30. But yeah, if you've got lots to do, sometimes they're pretty late nights too.
So what tips, if someone was looking to break into the funds management industry, what tips would you be giving them?
Sure. I guess from a starting point, you've got to be very passionate about stocks. It's the kind of industry where if you're not passionate about stocks, you'll have very average performance and you'll probably get chewed up and spit out pretty quick.
Yep.
To break into funds management too, I'd say it's quite difficult. I got quite lucky in joining a firm that was quite small and grew over time. But cracking in there, at a lower entry point, you're definitely looking at probably doing an unpaid internship,
Right. Okay.
and proving your worth. It's one of those industries that's just very hard to crack into, and you're probably doing some unpaid work and showing people you're worth it and worth the investment.
Yeah. Okay. So where would you see yourself in 5 years' time? Looking at where you are now.
Yeah, that's an interesting question. We've got a couple of global funds and a couple of domestic funds at the moment. So internally at Ophir, there's some opportunities to be overseas running money, but for myself, I'm trying to grow with the domestic team right now and take over some ownership of some of the investments there. I see myself probably still being Sydney-based in the next 5 years, but maybe running one of the funds myself.
Okay.
Time.
Awesome. So just a little bit about Ophir. So there's 3 main funds available to investors, or I think some of them are closed at the moment as well. And the performance, I just wanted to put the performance up here. So since inception, the Opportunities Fund has done over, 32%. The High Conviction over 23% year on year. And the relatively new fund, the Global Fund, has had a cracking 12, 18 months where they've done 65% in their first year.
Yeah, I mean, we're pretty proud of those numbers and they look amazing on the page, but there's a lot of man hours behind those numbers and a lot of pounding the pavement, going and meeting people, finding the investment ideas, modeling in the background, lots of time spent generating those numbers, which do look quite attractive. We're particularly, like, obviously the global ones got a little bit less track record there, hasn't been running as long, but we're and we quite like that, and that's an absolutely cracking year. Obviously not banking,
especially compared to the benchmark that was sitting at 13%. It's phenomenal.
Yeah, but I'm actually quite proud of the original one, the Ophir Opportunities Fund, being that above 30 per annum, because that's over a very long time period. That fund's been running for more than 8 years now. So
yeah,
it's nice to be able to get consistency, and we don't have obviously we don't have a 30% year every year, but to kind of average that over that period of time is pretty impressive.
Yeah, because we've been through different economic cycles as well. We've had a pandemic thrown in there as well. So you guys have had to weather the storm as such over those 8 years. It hasn't been all smooth sailing.
Yeah, we're fundamentally stock pickers when it comes down to it. So we're always trying to pick stocks that are going to go up regardless of the environment. I mean, historically, we've always had a growth bias to our funds because, particularly in small caps, that's generally where you make good alpha in the market. But we're certainly not scared to invest in something that's more of a value play or trading below net tangible assets and think can go up over time.
So I wanted to jump across and talk about when you're looking at investments, or when some of my clients might be looking at investments, what are the 3 key considerations they should really be looking at?
Yeah, sure. So the first one I've put in here, which says try and find a company that's taking market share in a growing industry. So that one's quite important, because if you're investing in a company and you think it's growing, but the industry which it's operating in is shrinking, it's a lot more difficult to grow, and you've got a much smaller margin of error because you're basically paddling upstream rather than downstream.
Yep.
If you can find, and I think you were going to talk about buy now, pay later a bit later on.
Yep.
If I can steal your thunder there and go, well, early doors with an afterpay, it was growing in a growing industry.
Gotcha.
People were using buy now, pay later more and more and more, and it was growing within that industry.
So the opposite to that might be, say, you look at print media or something of that effect, where print media is starting to to die down. They're starting to lose their market share as such, even TV and the advertising dollars and revenue that's coming through. So there may be someone growing in that industry, but as a whole, it's facing some heavy headwind. So your second point, Jeff, is make sure the company you are buying has a solid, experienced management team at the helm with plenty of skin in the game. So obviously they own shares in the company, or they're rewarded through bonus and shares effectively. That way you can sleep a lot easier at night if your money is invested alongside an experienced team. Do you want to add a bit to that?
Yeah, so I think it's quite important, firstly, that you look at the management team and they've got a decent amount of relevant experience. So you want to see that the company they're running, they've got experience running a similar company or something in an adjacent field for a decent amount of time. And then super important is that they own stock in the company. So they're experiencing the same ride as what you as a shareholder are experiencing. Their net wealth is tied into the performance at the helm. So you probably want to be opening the company's latest annual report, scroll down to the end and make sure that they appear in the top 20 disclosed shareholders, or if they don't, you can scroll up to closer to the top, find the REM report and make sure that they own some stock, and the more the better. Also, see if you can find somewhere in there their remuneration being tied into the performance of the company. Sometimes you have to check the AGM proxy voting forms to find that out as well. But combine those two pieces of information and make sure that the guys running the business are financially leveraged to achieving a good result for you.
Yeah, perfect. So probably one of the big companies that I've heard of recently was the new CEO of AMP that came in a few years ago. He was heavily tied in. So he had his salary, his basic salary that he was on, but he had this huge potential if he kept the share price above a certain amount that he could earn in shares. So that way he was heavily skin in the game. Obviously, it didn't work out that well for him and at the moment, but similar to that type of thing, structure.
Yeah, you definitely also need to be a bit mindful of what his performance hurdles are. So if we don't generally like ones which are just share price based, I would like one generally that has some form of earnings per share metric, even an earnings per share versus a peer set is quite good, because again, you want to be rewarding management for doing a great job at their role, not for being in the right industry that grows.
Yeah, gotcha. Okay. So again, coming back to the buy now, pay later sector where they've all taken off, you kind of don't want to reward everyone in the market, just those that are performing well.
Yeah, the ones that are taking market share in that growing industry, tying it into my first point. So like an Afterpay, which is certainly in a growing industry and in some ways defining that industry, but also they're increasing their market share within the industry as it grows. They're actually an interesting point when I go to that skin in the game, because you can sometimes get the reverse, and Afterpay is an example of that, where you have the founders are actually selling down their shareholding as the company grows. We're not necessarily against that. Sometimes it can be a poor signal for the stock if management's selling shares, but you also need to take into account
where they've come from.
And is it a decision that makes sense for them? You can't expect a Nick Molnar to go, I've got 99% of my wealth tied up in Afterpay shares. I'm not going to sell any of them, even though they've gone up so much over the past few years.
Oh, even the last 12, 18 months from $10 up to 160. Like, if all his wealth's tied in there, how does he buy a house? How does he live? You know, he does need to sell, take some profits off the table but still have a portion of the skin
Yeah,
in the game as well.
I'd be very worried if he was selling all of his shares and suddenly wasn't economically tied to the outcomes of Afterpay, but he still has a fair amount of shares in there. So I don't feel too bad that he sold some.
Perfect. And your last point, your third point, only invest if you have a grasp of the valuation of the business. So plenty of money has been torn up over the years by people investing into a business that they have no idea how to value. If you're facing a falling share price, it's a lot easier to hold your nerve and your stock if you can say this stock is worth X amount of dollars and I've done the research to back it up. So probably what I read from this is the American example, GameStop. So we saw the internet run with that, Reddit users and that type of thing, and they took GameStop up from $19, $20 up to $400, $500 a share. So doing the valuation and you work on that, you probably would have valued the stock around the $15 to $20 mark, and it was ready for a fall, which happened.
Yeah, so that's a great example of this point. So you can make some quick money by buying GameStop, and everyone else is clamoring to buy it, and the share price goes up. You have a short squeeze, but you need some form of peg on valuation. When GameStop went up, it was trading on a ridiculous on all metrics, all valuation metrics. You could do it with EV to EBITDA, EV to EBIT, price to earnings growth, just numbers that made absolutely no sense, particularly given it was a bricks and mortar retail games shop with no real view to earnings growth over time. In fact, that's why it had such a high short interest over there, and people basically thought the stock was worth zero.
That they viewed it as the next blockbuster. So the video.
Exactly. And my point here is, if you buy those shares and you haven't done the work and you don't know what it's worth, if the share price starts going down, you immediately reach for the sell button because you can't look yourself in the mirror and go, my hard-earned cash is in this stock and I think it's worth $20, $50, whatever the price may be. It just makes your job that much harder, and it makes you fret at a falling share price.
So for a retail investor talking about valuing businesses and things like that, obviously they can jump on Google, YouTube, and try and work out how you do value a business. But is another way that they could do it a lot simpler is either go to a stockbroker, use their research, or even hire a professional like a fund manager and let them do the hard work for you?
Yeah, like it's obviously a lot easier if you can outsource it to a fund manager, but I don't want to toot my own horn too much and say you have to give money to the professionals. Like it's very good for your financial literacy to do some research yourself. Definitely, you can jump on Google and figure out what all the various valuation metrics are and how to use them. And going to a stockbroker also makes a lot of sense, although you're limited to the stocks that they have research on. But at least if you just get some examples, you can see how their analysts are valuing businesses and kind of follow suit.
Yeah.
And just a lot of reading annual reports will help you a lot. The more you read from varying industries, the more financial literacy you'll gain.
So the more you read, the more you'll learn, is what you're saying, more or less.
100%.
Perfect. So I wanted to jump over to the buy now, pay later sector. So this is the number one question we get from clients, from potential clients, even people at barbecues. They come up, they probably do the same to you as well. They come up and say, oh, should I get Afterpay, Zip Pay, or is there anything else in the buy now, pay later sector that I should be having a look at? I think many people have seen the growth of Afterpay in the last 18 months, where it went from $10 last March up to 160. It's back down to 100, but many are seeing this as gambling or chasing the next big thing, saying, well, if Afterpay did that, what else in the buy now, pay later sector can do that? I see it as there's really no stopping this sector at the moment, as consumers continue to ditch credit cards in favor of interest-free installment payments. And then obviously COVID, with all the subsidies that the government handed out to people, obviously adding fuel to the fire, and people buying online and not having to go into the shops as well. Did you just want to touch on that a little bit?
Yeah, sure. So yeah, buy now, pay later, obviously very topical. Everyone's seen how well Afterpay's done. Zip's also done quite well, and their quad pay offering in the US is growing phenomenally at the moment. There's been another one in the US called Affirm that's listed recently, which has had similarly large growth, albeit they listed at a later stage. Yeah, like obviously went up a lot, and they've all pulled back a little bit recently. I would say the recent pullbacks probably got a little bit more to do with global markets and how the global market's investing in growth stocks versus value stocks. And there's been a little bit of a rotation happening recently towards value over growth. So that's got a little bit to do with why the share prices have fallen from their peaks.
And you think people are taking a lot of profits off the table as well, some of the profits as well from the last 18 months?
Yeah, there's definitely been a little bit of that. Also, there's been a little bit of a sell-off in stocks that have been seen as a beneficiary of COVID, which the buy now, pay later
has.
Yeah, definitely has, given a lot of spend has shifted to online, where that's the kind of hunting ground for buy now, pay later historically, albeit some of them have in-store offerings these days, but they're less popular there. Our view on the buy now, pay later sector as a whole is that it will keep growing. There's no doubt the sector will keep growing. There's always the question of how much am I paying for that growth, and am I paying the right amount for that growth, or am I overpaying for that growth? That's really what it comes down to. And
so we're seeing the big banks and major retailers, they're jumping in as well, which is only going to add fuel to the fire, whether that's creating their own solutions or whether they're buying or investing and partnering with a buy now, pay later provider to gain access to their platform and infrastructure already. And it's good for those providers, because then they get access to that customer data of the large retailers and the banks.
Yeah, the Commonwealth Bank entry into the space is actually quite an interesting one, because they've basically entered to compete with the existing buy now, pay later operators, of which Klarna is one, and they're invested in Klarna.
So they're competing with themselves.
They're basically competing with themselves, which is a bit interesting. Now, Klarna launched in Australia a while ago, but I think Klarna has kind of underperformed the sector. They haven't had the customer signups that they wanted. So that's why CBA's been happy to enter under their own brand and they're not too concerned about competing. Klarna's quite a large business in Europe already, and that's kind of been their ground where they've been winning the battle. So I don't think Klarna's that worried about it either. And Klarna's entry into Australia was more a bit of a shot over the bow for Afterpay, which was entering the UK at the time, to challenge Klarna.
You're coming over here to my market, we'll come over to your market.
A little bit of tit for tat there, 100%. But it's obviously yet to be seen, because CBA's entered so recently. But it'll be interesting to see if the target market that's taken up Afterpay, which has been millennials mostly, are willing to sign up to a buy now, pay later offered by a bank. Because I think a lot of the reason Afterpay's done well is because that cohort of customers don't trust credit cards and don't trust banks. So am I really going to start using the Commonwealth Bank branded buy now, pay later product when I have an inherent distrust for banks?
Right, gotcha. Interesting. So it'll be interesting to see how that plays out. But as you said before, it's a market that's continuing to grow. So a recent report said we're going to pass more than 4 million users of buy now, pay later by 2023 in Australia. And our e-commerce market will be worth 47 billion. That's huge. And then they're saying, well, the buy now, pay later, the transactions that they're expecting have already jumped from 3% to 6% over the last couple of years. And they're expecting that to go again, 166% up on top of that. So there's huge growth in the industry coming from scratch over the last 5-10 years as such. And yeah, it's going to be crazy to see. So this is another interesting point around, you just spoke about people moving out of the growth sectors that have also benefited from COVID, possibly overvalued due to hype as well. Some would say, some in the sector, not all of them. And most sector players cannot be valued on their earnings multiples like some of the other businesses that you would see as well. So, you know, you're looking at adding that revenue multiple range widely from 6 to 10 times up to 60 to 70 times even, which is ridiculous, right?
Yeah, well, this goes back to my point earlier about valuing companies and knowing how to value companies correctly, and then that giving you some comfort during the sell-offs that this stock is worth X dollars.
Yep.
So this is definitely high growth area, and it's in these high growth areas where you see stocks trading on revenue multiples as opposed to earnings multiples, because some of them buy now, pay later, most if not all of the market participants don't have earnings. They've got very high revenue growth, but they're spending a lot of money to acquire customers. So they're not actually making a net profit at the moment.
And also we're seeing them spend a bit of money on mergers and acquisitions as well.
Exactly. What I'd say on the mergers and acquisitions, and this is a point that gets talked about a lot because there's a lot of players now. What you'll see is historically, most of the acquisitions these companies have made have been strategic, not to get scale. A lot of that, they mostly grow organically to get scale.
Yeah.
And they make an acquisition to enter a new market. So Zip's purchase of QuadPay, for example, was so that they had a US product that was well regarded in the market. They see that as a much easier way to enter a market than organically, because you've got to get a whole bunch of clearances from governments and things like that. Much easier to just buy an existing player over there and then use that to grow.
So you've got the footprint already, you've got all the licenses, you've ticked all the boxes, and you can walk straight into the market rather than do 5-10 years worth of groundwork to get started.
Yeah, like for example, do I see any of the larger Afterpay or Zips domestically buying another one of the Australian-only domestic buy now, pay laters? Very unlikely. They'd rather just compete with them on marketing spend and crush them. Yeah,
gotcha. Do you think the Australian market, because we're seen as a leader as such in this space, it's open for international acquisitions of some of our smaller players?
I wouldn't rule it out altogether. It's just because we're valuing things right now on these sales multiples, it's very difficult for anyone to justify buying them as an acquisition target, and they're quite expensive. I'm not going to say it will never happen, because it could, and there is some strategic rationale for some people to buy them, but we're talking pretty expensive prices.
Gotcha. And probably the last point I wanted to touch on here was, obviously it's a relatively new market. It's had a lot of hype. They're getting a lot more customers. It's continuing to grow. Their market share of point of sales is continuing to increase. But this is really when there starts to be some regulatory risk, or ASIC, and the government bodies start to come in and start to have a better look and start to put some frameworks and structures about what they can and can't do. Do you want to touch on the recent reports or anything that's happened or anything that's set to come out?
Yeah, we find the regulation risk gets heightened every kind of 6 to 12 months around the sector, and everyone starts talking about it again. I mean, really, I think the risk is only around when you get a lot of complaints on the service, or there's people getting bankrupted, or things of that nature.
And that's hard to do when they're looking at less than $2,000 worth of sales, right?
Yeah, well, this plays to the advantage of Afterpay's business model more so than some of the others, because you can't really rack up a massive Afterpay debt unless you've been using the system for a while, and they kind of increase your limits you're allowed to spend over time.
Right. Okay.
So they're kind of self-regulating a little bit in that originally, I think once you first sign up, you can only spend 100, 200 bucks to go, and then pay it off with your installments. And once you've paid it off, then they kind of increase that customer's limit over time.
Right. So they do their own credit reporting more or less and give you a track record of how you've gone with repayments or increasing you up.
Yeah. So that's one of the issues. Most people go, oh, well, you guys don't do a credit check, and they kind of do their own credit check. Yeah, they get some that don't pay off the original amount, but we're talking a small amount, so it's not a big issue. What you should do, though, is check over time their percentage of bad debts, which they do release in their ASX announcements. Do check those, because if they start trending up over time and there starts being some issues, that's where the regulators are more likely to step in. So far, they've kept them quite under control, and there's nothing really of concern on that level. Yeah, definitely. It is a sector where there is some regulation risk, but we don't see it as a real big problem right now.
Perfect. We had a question that came through. Someone obviously starting off with investing. We spoke about diversification, using ETFs, index funds to get more diversification to start with. But they were set on this buy now, pay later sector, and they said, well, I want to buy Zip Pay because I've got $500, I can get 62 shares. Whereas if I get Afterpay shares, I can only get 4.6 shares. So it makes more sense to me to get 62 shares. And I went through the process with him and said, well, what about if Afterpay went up 50% and Zip Pay went down 50%? How would you feel about your 62 shares compared to your 4 shares? And he said, oh, I'd rather have Afterpay then. So just this whole process of, obviously you don't pay in this space, you're more in the millions or tens of millions of dollars. But really for our retail investors looking at that type of structure, anything to add on that point?
Yes, this is more of an issue you come across in the US, where you get a lot of shares that trade at $100 or more per share.
Like Warren Buffett's company, for example, at $360,000 or something.
Exactly, where it's quite prohibitive to buy shares because one share is worth so much. Look, at the end of the day, that's not. Yes, there is that hurdle for one share, but that example you've got there of 62 shares in ZipPay or 4.6 shares in Afterpay, I'll buy the 62 shares because I get more shares, is definitely not the right way to look at things. And you should really be looking at what the market capitalization of the stock is to compare like for like, because the company can always issue more shares. The company can always do a stock split or a share consolidation, which doesn't change the value of the company. It just changes the value of one share.
Yep.
So that goes back to our point earlier on the financial literacy and coming up the learning curve on what do the valuation metrics mean? What are the different valuation metrics? You should be looking at more on what PE am I buying this stock on? What EV to sales am I buying this stock on? What EV to EBITDA or EV to EBIT am I buying this company on? And how does that compare to its peers? And what's its expected growth rate versus its peers? Those are more the kind of conversations you should be having when you're looking to invest in a stock.
Perfect. And you spoke about market cap as well there. So looking at these two, for example, so Afterpay, their market cap stands at around 30 billion at the moment or something around that. And Zip, you're looking at around 2.5 billion or 3 billion. So they are very, very different on different levels, different scales, aren't they?
Yeah, exactly. So Afterpay, for example, is 30.6 billion Aussie at the moment, and Zip is at 4.4 billion Aussie market cap at the moment.
Okay.
And the terminology I used earlier, EV, is what's called enterprise value, and enterprise value is basically the market cap of the company plus its net debt level, or minus its cash if it's net cash.
Gotcha. So there's some interesting tips to start looking into before you start talking about share prices or this share over that share. Start doing the fundamental research, getting your financial literacy up before you start gambling, because effectively you're gambling with your money. You're not investing your money if you haven't done your research.
Yeah, and I definitely would direct you back again to what I said earlier about if the share price is falling, do I feel comfortable holding or buying more? If I don't, then I probably shouldn't have been invested in it in the first place.
100%. Perfect. So remember, always review, track your investments, jump on the back and do the research before investing anything. And should you have any questions, feel free to contact us directly. Thanks for your time tonight, Jeff. Appreciate it, mate. Look forward to catching up soon.
No dramas, my pleasure.
Thank you very much.
Ciao.